Hello everyone. In this part we're going to go over the accounting equation. The accounting equation is considered to be one of the major foundations of accounting. And basically it has three elements, which are assets, liabilities, and equity. So what are our assets? Assets are the resources owned by a business, and it could be in different formats like cash, inventory, cash that we expect to receive from customers, which we call them accounts receivable, supplies, and things that are going to be in this direction. Then we also have liabilities, and these are obligations for the business. So these are the rights of creditors that are the debts of the business, and we call them liabilities. Then we have the rights of owners, and these are called equity. And usually equity can be classified either stockholders' equity or owner's equity. If we're talking about a corporation, we like to call it stockholders' equity. If it's a sole proprietorship, it's a partnership, or even an LLC, then equity is referred to as owner's equity. So we usually have what we call the accounting equation, and this is how it's structured. And I hope you can see here where we have assets equal liabilities plus stockholders' equity. And think about anything that a business can own, like any kind of resource. Part of it is owned by the shareholders. Another part is like an obligation. Even on the personal level, I can go buy a $20,000 car and I only paid a $5,000 down payment. So a $5,000 down payment is considered to be my equity in this car, which is the asset. And the stockholders' equity is the $5,000, which is my right. And then the $15,000, which are the remaining balance, this is maybe like a loan that I got from the bank or maybe from the dealership. So if you think about any kind of asset that we own, consists of these two things, liabilities and stockholders' equity. In some cases, if I own my assets up front, I don't have any obligations against them, then the assets are equal to the stockholders' equity. But if I have everything that's based on a loan, like let's say I borrowed some money to acquire an asset, so I don't have an equity. So in this case, assets would be equal liabilities and the stockholders' equity would be equal to zero. So for businesses, this is very important that we know compared to or with relative to the assets that we have, how much of this is our right, which is the equity, and how much is an obligation, which is the liabilities. And that's why assets would always equal liabilities plus equity. Always remember that. The accounting equation has to be always balanced. So whatever we have on the left-hand side should always equal to what we have on the right-hand side. Liabilities usually are shown before equity in the accounting equation because creditors have first right to the assets. So in the worst-case scenario, if the company is filing for bankruptcy, then we have to pay the liabilities, which are our creditors first, before we distribute the remaining value of the assets to the shareholders. So now let's talk about business transactions and how they affect the accounting equation. An economic event or condition that directly changes an entity's financial condition or its results of operation is referred to as a business transaction. In simple terms, a business transaction is buying an asset, selling an asset, paying cash, collecting cash, providing service, receiving service. All of these are considered to be business transactions. And these are the transactions that need to be recorded in the books. All business transactions can be stated in terms of changes in the elements of the accounting equation. So every business transaction will have an impact on the accounting equation accounts. So let's see some example. And let's start with transaction A, which is assuming that somebody who's starting a new business. So on November 1st, 2017, we have a guy called Chris Clark. He deposited $25,000 in a bank account in the name of Net Solutions in exchange for shares of common stock in the corporation. So Chris Clark started a new corporation, and in this corporation he deposited $25,000, bringing this cash from his personal asset. Now it belongs to the corporation. So as you can see here, on the asset side, we have a new account now called cash, and it went up by $25,000. This A is for transaction A. And then under equity, we have common stock, which is the value of the investment that is brought by Chris Clark. So now we have the accounting equation balanced. Of course, we don't have any liabilities yet, so the accounting equation only shows assets on one side and stockholders' equity on the other side. So as it says here on the bottom, a corporation issues common stock to investors as proof of their ownership rights. So how we show that we actually own some shares or percentages in a company, it's through the common stock. Let's see transaction B. It says here on November 5th, 2017, Net Solutions paid $20,000 for the purchase of land as a future building site. And if you think about the two accounts that are affected here, we see that the company acquired land. And in order to acquire land, they had to pay cash. So if you look at here, we had a balance of $25,000 under cash. We had to use $20,000 of that to acquire the land. So the balance of cash went down to $5,000. And then we have a new asset, which is called land, and it's increased in value by $20,000. So the total value of assets consists of $5,000 of cash, and we have a new asset, which is land. The total is $25,000. So 5 and 20,000 is 25. And then on the right-hand side, we still have the stockholders' equity. It's unchanged because we didn't bring any kind of new investments or anything like that. So the total is $25,000. And you can see that assets is still equals stockholders' equity. Let's see another transaction. So in transaction C. On November 10th, 2017, the same company purchased supplies for $1,350 or $1,350 and agreed to pay the supplier in the near future. So you see here that we have a different kind of transaction. The business acquired supplies, but they didn't pay for it up front. They promised the supplier that they're going to pay them in the near future. So you can see here that cash is unchanged. Now we have a new asset called supplies, which is whatever they use for the business. By the way, Net Solutions is a consulting firm, so they may be using like papers paper or some stationery, things like that. So supplies, and then we have the land unchanged. So our supplies or our assets has increased by $1,350. So remember, it used to be $25,000. Now increased by $1,350. So the total is $26,350. Let's look on the other side. We still have our common stock, the $25,000, but we also now have an account called accounts payable. So what is accounts payable? The liability created by a purchase on account is called an accounts payable. So whenever we buy something on account and we don't pay for it, this kind of promise to pay the supplier or the vendor is called accounts payable. So items such as supplies that would be used in the business in the future are called prepaid expenses, which are assets. So in this case, now we're going to call them supplies, but in some future transaction, we'll see the term prepaid expenses, which are an asset. It's something we haven't used yet, so it's called prepaid expense. Now let's see transaction D. In transaction D, we have here a business earns money by selling goods or services to its customers. The amount is called revenue. So let's see what they sold. So on November 18, 2017, Net Solutions received $7,500 cash for providing service to customers. So how do you think this is going to affect their cash balance? Is it going to go up or down? When we receive cash, our cash balance is going to go up. So we used to have $5,000. Now we're adding $7,500. So the total is $12,500. Everything else on the asset side is unchanged. So we still have our supplies. We still have our land. On the liabilities and stockholders' equity side, which is the right-hand side of the equation, we still have our accounts payable. We still have our common stock. But now we have a new revenue account called fees earned. And fees earned is one of those things that affect your stockholders' equity. So you can see here that it also increased by $7,500. Again, keep in mind that the accounting equation has to be always balanced. So the asset side, $33,850, is balanced with the right-hand side, which is the liabilities and stockholders' equity total, for $33,850. So some other information that we need to know. Revenues from providing services is recorded as fees earned. So whenever we are providing a service, we call it fees earned. Some textbooks and some professionals, they like to call it service revenue. I personally like calling it service revenue, but in this textbook, we refer to it as fees earned. Revenue from the sale of merchandise is recorded as sales. So whenever we have a revenue from selling merchandise, which is something we're going to be talking in the future once we have an example for a business that sells merchandise, we don't call it fees earned, we just call it sales. And sometimes also people refer to it as sales revenue. Other examples of revenue include rent, which is recorded as rent revenue. It could be interest, which we also record as interest revenue, if we are the ones to receive the interest. An account receivable on the other side is a claim against the customer, which is an asset. So whenever we provide a service to a customer and that customer doesn't pay us at the time the service is provided, then we expect that that customer is going to pay us in the near future. So we record an account called accounts receivable, which is basically a promise by the customer to pay us in the near future. So instead of receiving cash at the time services are provided or goods are sold, a business may accept payment at a later date. Such revenue are described as fees earned or account on account or sales on account. And in such cases, the firm has an asset called accounts receivable, which is a claim against the customer, which I just tried to explain in the last slide. Now let's see another transaction, transaction E. So during the month, Net Solutions spent cash or used up other assets in earning revenue. Assets used in this process of earnings revenue are called expenses. So I want you to remember, we had the accounting equation where we had assets, liabilities, and equity. And also we have two other accounts that affect your equity, which are revenues and expenses. So now let's see this example of an expense. So on November 30th, 2017, Net Solutions paid the following expenses. They paid wages for their employees, about $25. They paid rent, $800. They paid utilities, $450. And they also paid some other miscellaneous expenses for a total of $275. Miscellaneous expenses, these are minor expenses that we spend here and there. They're not really that important to put them in a separate category. So we combine them all together in a category called miscellaneous expenses. So of course, all these kind of expenses were paid in cash. And that's why if we look at the accounting equation here, the total of these expenses was about $3,650. So that reduced our cash balance to $8,850. And the total assets are only affected by this kind of reduction in the cash value. So the new total is $30,200. On the equity side, we still have our liability and stockholders' equity side. We have the liabilities unchanged, which are the accounts payable. We have the common stock unchanged. Of course, we had our revenue, which is the fees earned. And now we listed 4 new expenses. These expenses are wages expense, rent expense, utilities expense, and miscellaneous expense. So these 4 expenses, because they have a negative impact on your equity, in other words, they reduce your equity, that's why they have a minus sign. So we put them within their minus sign, and then we add them all together with the liabilities on the other equity accounts, and the total should be also $30,200 to match the total value of your assets. Again, always remember, assets should match the liabilities and your equity. Now let's see another transaction, transaction F. On November 30th, 2017, Net Solutions paid creditors on account $950. So there's a key term here that is called paid. I want you to be aware of the word paid, because paid, this involves cash. So when we're paying something, this would send us a message that we have to reduce cash. So you can see here that cash has to go down by $950. So it went down from $8,850 to $7,900 because of this $950 payment. So why we paid the $950? To pay the accounts payable balance that we owe to our suppliers. So we go here under accounts payable, which is under liabilities, and you see that we used to have a balance of $1,350. We paid part of it, which is $950, so we still have a remaining balance of $400. Again, this would reduce your total assets value to $29,250, and your total liabilities and stockholders' equity would also match. It should be $29,250. So one of those things, again, I want to stress on that the accounting equation should always be balanced before and after a transaction. Let's see another transaction, transaction G. So here it says, on November 30th, 2017, Chris Clark determined that the cost of supplies on hand at the end of the month was $550. So if you recall, we purchased supplies, Chris Clark purchased supplies for the business for a value of $1,350. At the end of the month, which is November 30th, the leftover is $550. Just by subtracting the difference, you can tell how much worth of supplies have been used during the month. So the cost of supplies on hand, not yet used, at the end of the month is $550. How did we figure this out? So in other words, you have to see here like the $800 is what we have been using. So if we take $1,350 minus $550, which is our leftover, then the amount of supplies used is $800. So the $800 worth of supplies must have been used during the month. So now we have to record a new transaction for that. We need to reduce our supplies by the 800 to bring the balance down to 550. So you see here 1350 minus 800. So the new balance for supplies is 550. And then we need to add another expense account under stockholders' equity, which is for $800. We call this supplies expense. Please don't mix between these two accounts. We have supplies, which is an asset, and we have supplies expense, which is an expense account. These are two separate accounts, however, they're related. So supplies is an asset. Once we use it, it goes down. Supplies expense is an expense account that shows how much we used in terms of supplies. And the last transaction here that we have as an example is transaction H. This is about paying back to the shareholders. When we pay back to the shareholders, we use an account called dividends. This is called dividends. So on November 30th, 2017, which is again the end of the month, dividends of $2,000 were paid to the shareholder. It was Chris Clark in this case, only one shareholder. So dividends are distributed of earnings to stockholders. So typically it's coming from the profits of the company. And in this case, it's paid in the form of cash. So we see here that cash is decreased by $2,000. So it used to be $7,900. Now it went down to $5,900 because we subtracted $2,000. And then under stockholders' equity, we'll have a minus sign for the $2,000 because that would reduce the equity by $2,000. This would keep, again, the accounting equation balanced. So the assets total is $26,450. Liabilities on stockholders' equity total is the same, $26,450. So this slide here shows a summary of the transactions that we had, transaction A through H. And you can see that after every single transaction, we can calculate the balance. So we started with transaction A, where Chris Clark invested the $25,000 cash. Then we had transaction B, when the business acquired land. And then you see the new balances. And then after each transaction, you can see the balance that happened after that. The balance has to be, again, equal for the assets, or the assets should equal the liabilities on stockholders' equity. After all these transactions, you can see the final balance for each account that we created. And the total here is $26,450 for the assets, and for the liabilities and stockholders' equity is $26,450. So let me stop at this slide, and again, in the next slide, we'll start to explain the financial statements.